In this presentation, we will continue on with our corporation comprehensive problem, focusing in on the balance sheet, focusing in on the liabilities and equity section of the balance sheet. Last time, we had created the assets section of the balance sheet from our adjusted trial balance. Our goal here is to convert this adjusted trial balance to a plus and minus format. In other words, once we find a home for all of these accounts on the adjusted trial balance, we will be in balance. How do we know that? Because it's just another way to represent the double entry accounting system. This being represented here in terms of debits minus credits equaling 0, debits equaling credits. Therefore, if we represent that on the other side, then of course on the balance sheet, we're just reformatting that to mean assets equal liabilities plus equity. We're going to go from the liabilities on down now and just find a home. We're going to find a little bit of a trick here when we get to the equity section, and that is why some people recommend doing the income statement first. You'll often see that in textbooks. But again, this isn't too difficult, especially if we're using software to do this conversion. When we do it by hand, we'll have to do a little bit more work. But if you have a properly formatted adjusted trial balance, it's pretty easy to figure this piece out, so we'll talk a bit about that as we go. First, we're going to do the liabilities section. So that's going to start with the accounts payable. We break out the liabilities section between current and non-current. So we're going to represent current by saying current liabilities and then colon, just as we did with every other subcategory we have had. Now we're going to pull over the accounts payable as a current liability, one that will be due within a year's time. And that's what a current liability is, by the way. And so we're going to put over accounts payable here. Now we're going to have it in the inner column, not representing debits and credits, but a subcategory. We have a credit over here represented by the bracketed number. We're not going to bracket over here because we're not using debits and credits. We're just using a plus and minus format. Then we've got the wages payable. We're going to pull over wages payable. Same idea. Then we're going to pull over unearned fees. Same concept. Usually there will be less liabilities than assets, so it's usually an easier section of the statement to produce. In this case, we don't have any long-term liabilities, and therefore that's actually a bit of a problem, because we might think, well, how are we going to break out short-term and long-term, or tell our reader that there are no long-term liabilities and that they're all current liabilities? Well, we're going to do it this format. We're going to say current liabilities. But then when we sum it up to the outer column, we're just going to call it total liabilities. We're not going to then go back in and say current liabilities and then say total liabilities right underneath it with the same amount, or even indicate long-term liabilities 0. We're going to just basically put this total here. When you first read the financial, you might get a little caught off guard and say they missed the current or something like that on it. But that's typically often the way the financial statements will be, in order to be them as concise as we can be, to say, hey, they're all current because they're in the subcategory, and their total liabilities, those are all we have. This total then, of course, is going to be the 11,000 plus the 1,005 plus the 1,000. Then we're going to go to the equity section. Now the stockholders' equity section is for a corporation because of, obviously, we are stockholders. Within the equity section, we're going to have common stock, and we're going to have the additional paid-in capital. Those are going to be pretty straightforward. Those are right here. Common stock is what we invested in the company, but it's at par value. Again, it's a credit balance here. We're going to flip the sign and just make it a positive number because we're not representing debits and credits on our financial statements. Then we have the additional paid-in capital representing what was paid over and above the par value. Again, credit over here, we're going to represent it as a positive number on the financials. Then we have retained earnings, and we're going to put retained earnings on there at 5,600. And you might think, well, where did that come from? That's kind of weird because retained earnings has 0 in it. And the thing with this is where it's confusing on the balance sheet, that we have to do a little bit of work on the balance sheet in order to figure this out. Part of that work we will do on the income statement, but it's easier to see it kind of as a whole here, to see that what the balance sheet is as a whole, the full accounting equation, assets equal liabilities plus equity. So what we're going to see then is that the retained earnings, this is really the beginning retained earnings, even though The trial balance will often say as of the month end, as if it's a point in time, only having one date. It's really got permanent accounts and temporary accounts. So like this top half of the trial balance is as of a point in time. The dates don't matter. It doesn't matter what the range is. But this bottom half is really a temporary thing, and we need to know that the range is from January 1st to January 31st in this case, 1 month. And so this number represents really the beginning retained earnings, which is 0 because it's the first month of operations. Once we close everything out to it, temporary accounts, including income statement accounts and the dividends, then it'll be what it will be at the end of the time period. So if we do that, if we have a pretty clearly defined trial balance, it's really easy to do that. We say, well, the net income is $7,100. How do we get that? 29,000 credit minus all the expenses, 6,500, 1,300, 11,000, 1,000, 1,000, 1,001. That's 7,100 net income. So that's what's going to be included in retained earnings on the balance sheet. It'll also be what's on the income statement, 7,100. And then we've got this other blue account, dividends, which represents what was taken out of the company. So we can see it's a contra equity account because the equity accounts will have credits which will win. This is a debit, kind of like an expense. Therefore, it's going to bring down total equity. We also know it's going to bring down total equity because equity represents kind of what is owed to the owner, and dividends represents what the owner has been paid, what the owner has taken out, and therefore it's going to decrease equity. So if we take that 7,100 minus the 1,500, we get the 5,006. So if you didn't have as nicely a formatted trial balance that didn't calculate net income for us, then you'd have to do a little bit more math. We'd have to say, okay, well, if we had 2 columns here and this was on the credit side and all the expenses were on the debit side, we'd have to say that the credits minus the debits to pick up this retained earnings, meaning we would just have to do the math, 29,000 minus 6,500 minus 1,300 minus 11,000 minus 1,000 minus 1,000 minus 1,100. And that's going to give us the 7,001 minus the 1,500. So that'll give us it. And the reason that a lot of textbooks will say that we should do the income statement first is because we're going to do that math on the income statement, and it would be too difficult to do that 2 times or something like that. But usually most book problems are pretty small, so doing the math on that isn't that easy. 2, if you have a well-formatted trial balance, you don't even need to do the math because it's pretty much done for you already. 3, if it's in Excel, it's even easier to do the math because you just highlight, these cells and it'll do the math for you. So, and 4, it's just that the balance sheet's better to look at from a big picture standpoint, in my opinion, and then go through and look at the other financial statements. It's easier to go from top to bottom, assets, liabilities, and then equity. It's easier to see how everything fits together and is in balance, and then break out this one number, which is going to be retained earnings, between the other 2 accounts, which is going to be the income statement and the statement of equity. So that's going to give us the total stockholders' equity, which is the 30,000 plus the 70,000 plus the 5,006. So total equity then is all of this. This adds up to 105,006. Of course, credits minus debits. Now we're going to left with the bottom line, which is total liabilities and owner's equity. We should have stockholders' equity, but total liabilities and equity is going to be the bottom line number. That's going to be only the outer columns, 13,005, 105,600, to bring us to the 119,100. So we can see how that all fits in over here. We can see, okay, so we had assets are going to be here. That's going to add up to the total assets, 119,100. And then everything else, who it's owed to, meaning this is what the company has in terms of value, measured in dollars. This is who the company owes that value to. Liabilities, a third party, and then equity, the owner, is going to be here. Now we found a home for every account on the trial balance. That's why we're in balance. That's why this works. However, we kind of cheated here in that we grouped all of these numbers together. And what we're going to do now is find their own home by breaking that number out into their temporary components, breaking them out into the income statement and statement of equity.